Hello and welcome to Property TV. I'm Stephen Galpin and this is Property Matters. Now, for those of you that follow us on Sky TV and YouTube, you will have seen in the last week or so we produced a programme, an extended programme of Property Matters, dealing with the Zoopla report on rentals across the country. Now, the conclusion of that report was that the rental market should, after a bit of a dip this coming year, reinstate itself as a good solid investment for buy-to-let investors. However, there is without doubt a trend, forced to a degree by the government's tax changes and other restrictions, towards encouraging institutions to rent out property in a buy-to-let situation rather than individual owners. Now, I'm guessing that this is a way of chasing taxable money far more easily. If it's a limited company, it's easier to control the income and look at it and raise the appropriate tax levels. And with individuals, that does become rather more difficult. But what I want to do is just go back to first of all, to the 60s, which was when renting out property was a problem. A problem then was that you rented your property out and you could never get it back. You had what you called sitting tenants, and once they were in, they were in. And it was only the likes of Peter Rackman in our London's Notting Hill that used rather unconventional and not very nice methods of getting his properties back that it was possible. So in the late 80s, Margaret Thatcher's government decided to try and encourage owners of property to buy more, to put it onto the letting market, to help with the housing crisis. And part of that encouragement was the birth of the assured short-hold tenancy, which we live with today. Now, the idea of this was that both the landlord and you had a 6-month period of surety where you could stay there for 6 months as a minimum, and the landlord would have to let you stay there for 6 months, but nevertheless he could get his property back after 6 months. That was the critical factor. And it was that caused the explosion in buy-to-let properties as we know them today. Now, that's fine, but we need to look at some of the consequences of these letting properties going over to institutions. It's going to be far more regulated. The rules and regulations are going to be far stricter. They'll work to certain criteria. The government will no doubt encourage it. And I see in the property press this week, one company is looking to purchase over 500 homes in one go to put onto the letting market. Now, that's fine. They have the capital, they have the resources to do that and do it in a considered way. Where I start to worry is all the individual people that have reserved apartments off plan, ready to put into the buy-to-let market. And if we take Canary Wharf here, for instance, over the next couple of years, there's something like 20,000 apartments coming onto the market. I'm not sure what that will do to the rents in this area. Will it depress them? Will there be a huge oversupply with people moving out of the city centres to go to the countryside to look for more space, to work from home? Is this oversupply going to cause a hiccup in the property market? And once again, the institutions can afford a hiccup. We as individuals can't. So I'm very concerned about the prospects here, and I would urge anybody who is considering going into the buy-to-let market to do their sums very carefully. Don't forget to allow for the voids in rental income that you might experience as a landlord. Don't underestimate the cost of repairs, servicing and refurbishment once the tenancy is finished. So do be careful. I think we will have a solid rental market in the coming years. But we do need to urge caution. We do need to look at what the market will stand and what the cities themselves can reasonably sustain as a rental market. All right, take care. See you next time on Property Matters.